Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome or welcome back to this week's edition of the Systematic Investor Series with Jim Kasang and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Jim, wonderful to be back with you. I was just about to say, how have you been? But we spoke not very many days ago. So how are you?
Doing well. Chicago in the spring. My son got into boarding school and he's getting ready. So a moment of change and renewal. So things are good.
That's good to hear. That's great to hear. Well, we've got I always say this, we've got a great lineup of topics. I think we do. They may be a little bit different to what people hear us talk about. I think this will be influenced by an episode that we will refer to a little later in our conversation that we just released a few days ago. A very deep conversation with Demetri Kofinas. But before we get into all of that stuff, I always love to hear kind of things that we're not really going to dive into today, but just things that you may have come across your radar, something that you think is interesting, could be funny, anything, or is it just spinning with all the stuff you have going on right now?
There's so much going on. It's like, I don't even know.
Let me throw a couple of things to you then, if you don't mind, then you can see where this lands. Obviously, a couple of things that I just noticed is just like a, kind of thing. Wow. I mean, so obviously Warren Buffett stepping down after all these decades. I thought that was interesting, probably a good time. Certainly he's done incredibly well. Not a lot of to that, but I do think it's worth recognizing. But one thing I did pay attention to is the more and more the narrative about how some of the US, let's call them elite universities, seems to be asset rich but cash poor at the moment, and they're tapping the bond market to basically get liquidity. And I'm just wondering, is this something we should be paying attention to, or is this something private equity investors should be paying attention to? Because that's obviously where a lot of their money has been invested.
Two great and important ideas. I'll take the last one first. There is a way, we will talk about this on the show, of liquidity that is coming off the system. It's getting pulled off the system. We're reaching the 5-year anniversary of the refinancing of debt. And that's not just debt, by the way. That's equity. That's venture capital. That's everything. And I don't think it's a coincidence that they also, are at that point where they need those things. People have we are notorious for our short-sightedness, our needing to satiate and take care of the things we need now and not worrying about the future. That's usually not 1 year. Usually that's less than 10 years though. And guess what? 5 years is a big kind of milestone for lots of reasons. So I think that has something to do with it. In the same vein, the rhyming piece, I think this is interesting. I don't think Warren Buffett's retiring at this moment it's perfect, right? It's perfect. Why is it so perfect? And it kind of feels that way for a lot of people, like the end of an era, the beginning of an era. Why? We talked about the fourth turning all the time. Guess when Warren Buffett started? He started in the 60s and 70s, right? And that was, at that 40, 50 year mark, right? And the principles that he believed in, that the value investing, kind of also protecting your margins in a increasing interest rate inflation environment. He started during an inflation environment. Insurance, the one thing he started with, by definition, is a negative working capital business that excels during times of inflation. That's part of why he excelled. And why? Because he understood that their profit margins increase and that would offset multiple contraction in a world of higher inflation, lower multiples. And he dramatically outperformed in his first 20 years. So those things happen again, much like the fourth turning does, right? Because of these generational things. And he started and he's passing, and now a new generation who has not experienced this will now begin to experience. So there will be a new Warren Buffett. You can hear me here. We'll talk about it in 40 years. We'll see. We'll say who that is at that point.
Yeah, no, absolutely. And of course, it is very interesting to see that he's passing on the baton, so to speak, at a time where he's got so much cash that needs to be invested. So it'll be interesting to follow. The last thing, two last thing I had on my little radar that I found was interesting. Something that we will talk to, but in a different way. But did you notice the move in the Taiwanese dollar?
Yes, hard to not note that.
Okay,
that was that was a
not a currency I normally follow.
Standard deviation move. There's definitely something there. I'm not going to sit here and try to opine on it and sound like an idiot in the face of people who have much probably better views on that. I know when to kind of draw the line. I can do a lot. I can speculate, but if there's a listener, by the way, who has a deep understanding, believes they understand all of the reasons behind that, we're happy to get a note on that.
Yeah, no, absolutely. And the final thing I just noticed over here in Europe, of course, you may be also paying attention to what's going on in Europe, of course, with your roots. It's just, once again, we see this swing to the right. Romania this time also being influenced, let's call it that, by the Trump family, with Donald Trump Jr. Going to Romania just before the election last week or the week before. Yeah, interesting developments from a political point of view. And also because if it goes in that direction, it'll be someone who is not necessarily that keen on the EU. Guess what? Trump is not very keen on the EU either. So interesting developments.
Trump is lots of things, but he's most of all a magnet. And magnets are implied that they pull things forward. The other side of the magnet also pushes things away. If you look at what happened in Canada and Australia, he's actually pushed people away. So he is unequivocally a powerful force, but that disunity part, which we may talk about later, is a critical thing.
Absolutely. All right, quick run through of the sort of trend following part where we are right now. Obviously, May is off to a quiet start. I would say we're 7-8 days in compared to April, of course, which was kind of a wild ride. May seems pretty calm right now. Some of the same themes are continuing. Gold doing well. Even some of the agricultural markets like live cattle doing well. Equities still being supportive. We'll come to that towards the end of our conversation, your views on that. And also the dollar has regained a little bit of the ground, after a tough month of April. But as I said, reasonably quiet. My own trend barometer stands at 50, has been around that level for a while. So it's a little bit positive, and there has been a recovery in performance the last couple of weeks, but it's not, that strong. As of Tuesday this week, since we're recording on Thursday, BTOP 50 down 70 basis points in May, down 4.22% for the year. SocGen CTA index down 73 basis points, down 7.5% so far this year. SG Trend down 87 basis points, down about 10% for the year. And the short-term traders index doing obviously better in this environment. It's flat for the month of May. It's down about 1% so far this year. Looking at the traditional indices, obviously you wouldn't really believe that there had been a big crisis this year already. But MSCI World is up 1.15% as of last night in May, down 0.25% for the year. The S&P Aggregate Bond Index down 44 basis points, but still up 2.5% for the year. And the S&P 500 up 1.13% in May so far, down only 3.85% so far this year. Cem, we've got, as I mentioned, quite a long list of topics. I'm going to start out with some of the ones that you sent over, and then we will interchange with a few things I thought about, and then we'll finish up with your view of the equity world right now. I know people love to hear your thoughts on all of that, but just let's start with kind of the macro side of things. And in particular, you have a few thoughts on something that I think a lot of people is very familiar with, but also very interested in finding out. And that is, what about inflation? What about recession? What's coming? What's not coming? So let's start with that.
Yeah, just to put a shape around this, I think it's important because people talk about this much like they talk about everything in two directions. Is inflation coming or is it not coming? Is the recession coming or is it not coming? Well, let's actually add some texture to that. I have a ongoing strong belief. You've heard me say this, and I think this is, if anything, just a acceleration of those longer term trends that you and I have been talking about for 3 years, at least, if not 4, which is the populism, the protections, et cetera. Well, what do those movements, what do those policies do? And I just want to be clear, and just to reiterate for listeners, that takes money from top 10%, tries to move it down to the bottom, let's say 40%, right? Moving it to the bottom 40% then creates inflation, because the velocity of that money there's a lot more velocity. Everybody who's on the bottoms has to spend pretty much everything that they get, whereas the people at the top put it into assets, right? So the net effect, though, and if you accelerate it at its extreme, it can be pretty dramatic, is actually ironically more jobs, right? But with lower pay. If that makes sense. And that at the same time, you get more inflation, but the net result, particularly under a protectionist type scenario where things become more inefficient, are less profits for corporations. And importantly, it can be for certain periods recessionary, but in a very kind of counterintuitive, slow recessionary way, not a recession we've been used to. If you look at 1969, 1970 as our most recent example of something like this, you saw a very, very shallow kind of 1.5, 2-year recession, about 1.5 years, where actually in earnings did very poorly in that period. Markets did poorly. But to be clear, it's not some deep recession that everybody thinks about recession in recent history. We're so used to these V's and these big implosions. And by the way, it wasn't a time when the 10-year bond kind of came down and helped with poor equity performance because inflation was sticky. And so I think that's more the shape that I'm talking about. Everybody's so focused right now on the recessionary part. Are we having a recession? Or are we not? Everybody assumes a long bond will kind of help people into an equity kind of decline. And my view is we will probably go into recession because, and primarily because we have gone so far in creating the top 10% is now 50% of retail spending in the United States. Right? The top 10% has become such a big part of consumption that pulling money from there, the wealth effect, right, will ultimately be much more painful on a total consumption level. But that doesn't mean the employment numbers will be bad. And by the way, the employment number was bit warmer. I mean, it's the first number since tariffs, et cetera. But I'm not saying that those numbers can't come down either. But I think you can take money from the whole, bring down, consumption barely, if that makes sense, while still adding jobs or keeping jobs stable, and get this really weird recession where it's more of an earnings recession, margins compress, and yet inflation stays high.
So it's a stagflation, right?
Yeah, it's stagflation, but it's stagflation in a way that's like, I think people assume that there's all kind of range of stagflation.
Sure.
That could be hot inflation with low growth. It can be, no inflation with recession.
Sure.
Right? Like deep recession. And I think people are more like, people think we're going to no inflation with a deep recession.
Right.
And I'm here to tell you, I think it's actually more inflation. I think the one thing we can say confidently, and this is what the Fed is telling you, is that we know inflation is coming. Or at least the supportive effects of inflation are coming. What's less clear and uncertain, as the Fed is saying, is what the taking from the wealth effect and putting down to the bottom, right, will do over what time period to growth. And if there's a reason they're staying pat is because they know one thing and they're not sure about the other. And the timing, by the way, is a bit uncertain. Think about it. If you put a tariff up, and this is the last thing I'll say about this before we move on, is if you put a tariff up, one thing we know for certain is that those jobs have to be replaced by entities that are more local or that don't have those tariffs, or the price of goods that needs to go up. Well, those supply chains will have to be repopulated. Somebody has to take those jobs. That is massive demand for jobs, not a subtraction for jobs locally. Think about how many jobs have been shipped overseas. Okay, yes, it's inflationary for sure if we bring them back. The question is, at what point do those jobs get recreated? Over what interval? How do they get recreated? And so, is that a 3, 6, 9 month, 1 year recession before the power of all that job creation here creates GDP growth, but ultimately over that period hits margins? My point is, it's a much more nuanced thing that people are painting, and I think you really have to think about it in that nuanced way. Otherwise, you totally miss the forest for the trees.
Yeah. No, I think, and as you say, I think it's pretty difficult actually to know exactly how this will play out, even in the how. I mean, you can think about some jobs being replaced by robots. Obviously, that's not necessarily inflationary, but and at the same time, obviously, the U.S. is hitting hard on, or clamping down hard on immigrants who may historically have taken some of the lower paid jobs.
Yep, absolutely. And I think, a couple of other interesting things that happened this week, Microsoft's earning, I thought was very interesting. Why? I mean, that was the one question mark, right? How will Microsoft do? And Zella came out and said, you know what? Inflation's good for software. And he's right. He's right. On our basket of stocks that will outperform in periods of structural inflation, it's not just companies like insurance businesses, like I mentioned, but it's value, good discounted cash flow, software businesses and telecom. They not only, everybody should increase revenue during these structural periods. That'll be great. Growth will be great. Whose margins will increase during that period and who will get excess demand during that period? Software, to your point. So again, if you're growth software and you're looking for venture money, good luck. But if you're Microsoft, that's pretty awesome.
Yeah. So we know that Jerome Powell has been out saying that they're going to take a wait and see approach. They don't feel certain about moving rates right now either way. I thought that was interesting, actually. I thought he said in his latest press conference, actually, he kind of didn't just say when to cut. He also said, if maybe we need to go the other way with rates. I thought that was interesting. Anyways, we also know that the biggest expense now for the US in its budget is interest rates, payments on debt. How do you think about just in the issuance of debt, so to speak? We know you and I have talked in the past about, did Yellen miss the big opportunity to go long in terms of financing? She didn't do it. It's all pretty short-dated paper. But how do you think about all of that? Because that's another challenge, I guess, for the...
Yeah, there's like 4 questions there, and I'll try to address all of them. They're all very important. Is one, first, the easy one, Yellen, that was politically motivated.
Right.
I'm not a Trump supporter, a Biden supporter. I don't really care. People are people, and people respond to incentives no more than in politics, right? But if you think Janet Yellen, who worked directly as the Treasury Secretary for Biden, wasn't doing what they were doing in in the election period, or in a, you got it all wrong. By the way, that's not an accusation. Biden, same damn thing's happening with Trump. Trump's trying to influence the Fed and get him, this is just how it works since the beginning of time. So that's my view there. The short-sightedness versus long. And I don't know what president since FDR has been, long-sighted.
Right.
Like, and then guess what? Takes a crisis. And we've talked about that. So that's that piece. In terms of the Federal Reserve, they're in a box. We've talked about this for some time. The box is getting smaller and smaller and smaller. I don't envy Powell. Everybody's he's becoming the fool. He's not the fool. He's just in a it's like how Arthur Burns. I mean, Arthur Burns is another story, but like people during those periods, they're going to be made the fool. They're the fall guy. It's not their fault. Just like Volcker seems like a hero. Volcker was not a hero. He just he had the ability to do a big thing at a big important time. It's a very, different situation. But the Fed at the end of the day is stuck. And by the way, the politics isn't helping, as populism is kind of the force. It makes sense that that's the biggest issue. I want to highlight, I don't think enough people are talking about this. Actually, this is one of the biggest things politically. And it's just crazy to me that this is not on any media platform more highlighted as just a big picture thing. And I don't think there's a coincidence, is that Elon got kicked out of the administration. I want to say that loud and clear. That was not like Elon deciding yes, he had incentives to leave as well, right? But, Elon was used to, they both used each other, right? But like used his voice, his media presence was used to get the administration in. As part of that, they were like, let's try this grand deal where we take the supply side, richest man in the world. We're talking about, corporate interests at their core, and try and bring them into a big grand tent with all this populist protection side, which is who we really are, which is Lutnick and Navarro and Bannon and all those other guys, right? It was always an unstable equilibrium. And right away, there was an effort and a belief by everyone, by the way, it was palatable, the excitement. Oh my God, this Trump administration is different. These guys are business friendly. I said, I was very, very public with this. Good luck. Good luck. Like, I didn't think it ended in 1 month, by the way. But yeah, why did that happen? Well, yeah, if at the end of the day, you try and do supply side economics, the first budget they put out, by the way, had massive fiscal cuts. We had Doge, cutting massive jobs, cuts to the poorest of the poor, and tax cuts to the rich. And a hope that if they push the market down enough, that the Fed would react, right? And get the 10-year down, and they get a supply side response from that too. Within a month, that whole idea imploded. And not just imploded like from hey, it didn't work, it didn't get the 10-year down, the Fed didn't respond, sure, that didn't work. But politically, in the first 100 days, is the worst approval rating since 1940. Well, Trump is a political animal. He's a marketer. That's how he got here. And importantly, since the 1980s, he is a populist. He has talked about what he's like. The one thing you got to give him credit for is he has had this belief. He's like a broken clock. If he has this one belief, it wasn't the right belief then, but right now it sure is. And now people are like, he was right all along. Okay, sure. But that's where he really is. That's his base. That's what got him here. He knows that. The Bannons, the Lutnicks, the Navarros, and guess who's now running the show. And so they've abandoned the supply side, old school Republican, corporate interest, supply side economic model. By the way, the only way out of, and it was always doomed to fail in my opinion, but the only way out of an inflationary, stagflationary mess like we're in is to go back to where we were, that was working for, X number of years. The problem is inequality, right? And so populism is what's trying to fix that inequality. It's the political forces, and Trump knows if he's going to survive in the midterms in a year and a half, he's got to get back on that. And he pivoted so fast back towards that side. Nobody's talking about this. The administration is not the same administration we had 2 months ago,
right,
or 3 months ago. It is a different administration. By the way, when I say he got kicked out, everybody's like, proof. There was literally yelling. This is well documented by the Wall Street Journal, by others, top of their lungs, between Dissent and Elon in the halls of the White House right before he started to depart. And they well document what was being said, very much accusation, like not just about Doge. And guess what? I said there'd be pitchforks. Literally had massive fires at Tesla, dealerships. What a bad political idea. Again, to bring the richest man in the world in and try and do supply side economics during a populist period. Who do you think is going to be the ire of the anger? And so convenient for Trump to just cut the cord, set it off to sea. And so that's what he's done. Again, nobody's talking about that. Couple policy changes that have happened very quickly since then, which I think are very, very important. One, the Congress is now trying to pass no taxes on any tips. That is a huge deal. Again, something nobody is talking about. That is massive fiscal spending to the bottom.
Yeah. but not
it's the
new.
exact opposite of what they were talking about before.
Right. Well, they talked about no tax on tips during the campaign, right? As far as I understand.
Yes. But in terms of the actual policies that got pushed through at Congress, right? And what was being driven by the Elons and the Bassents in terms of supply side economics, which is that original budget proposal right? That was a cut to the poor, give to the rich. It was very clear. It was not close, right? And by the way, like the key there was we're going to get spending down dramatically, and that's going to help the 10-year, right? That was and then we're going to respond with market-friendly forces. No tax on tips. Also, a 20% increase in national defense. $150 billion a year increase. That's also new. So spending cuts, like that didn't last very long, right? And so, cutting government, DOGE, right? Like, okay, we cut some, but are we just now just increasing it back to government spending just in a different sector?
By a factor of 10.
So my point is, I think that's an incredibly important thing. And that's, we were talking about the one thing that we were concerned about, and I mentioned it here in January, in the short term, in terms of short term, meaning 1 year, 2 year path versus, let's say, 10-year. And it was, well, would this administration succeed for some short period with doing supply side economics? And I said, they might be able to, but the backlash will be dramatic. Just didn't think it would be in a month or two. And so now that's off the table is my point. And now we're just seeing acceleration, which is what we saw during Nixon. We talked about this. They tried with the supply side economics. You probably remember me saying this. They tried. It didn't last long before it got to price controls and Watergate.
We talked about the Fed. We talked about this new spending coming in. There's something that's kind of interesting that I saw that the good people over at Odd Lots had written about recently, and that was what had happened to CDS on U.S. debt. I don't know if you follow that, but it actually picked up, which is kind of as I think Tracy Alloway said something like, it's kind of a weird thing that you have, even the CDS on U.S. debt, because if U.S. debt defaults, I mean, what's left, kind of thing, but. Yeah.
So you have to understand those things are always by definition there's a risk premium to the tail, and it's dramatic. It's the one thing that everybody's short is the tail, whether you're thinking about, this is the ultimate tail, right? A default of the US dollar would be the ultimate tail, right? But it's the one thing that will cause even the hint, like it doesn't have to even happen, right? And that's why when we see things that are clearly like 0.1% probabilities, 0.01% probabilities, it can still freak out the bond market. Because the risk of, the magnitude of the risk is so big, and it's the one thing that nobody can hedge, or if they can, this is the only place they can. And so you see some crazy bumps and things, and that's just risk premium. And it's not risk premium just like volatility risk premium, it's skew risk, tail risk premium, which is just sometimes. It's crazy. But it's like, well, if it happens, there's no way to hedge it. It's the end of the distribution.
Yeah. And I think I might come back to this as far as I remember from some of the other things I want to talk to you about today. But I guess the changes, and maybe that's what you were referring to, is that if we went back 6 months, the probability of this, people would say 0. But now that 0 is not 0. I mean, that probability is not 0. It might be small, but it's not 0 anymore.
Yeah. And by the way, it was never 0. We can call it risk-free. It was never 0. The perception or fear and yes, it is likely higher than it was. Yeah. But it's still approaching 0, right? I mean, at the end of the day, you tell me if there's a situation where things got so out of hand, what would happen? Would we default in terms of a literal default? Or would we just print money and monetize? So the same thing. Yeah. You can print money and monetize, right? And by the way, I do think that's going to happen.
Sure.
There's only one way out. You fear. Look at where the exits are, and that's where ultimately everybody's going to leave the party. I don't want to focus too much on it in the sense that, but I do think that look, it's not just. That's the tail on the distribution in a vol environment. When the whole volatility goes up, the skew goes, the amount that the tail goes up is even more than, let's say, the at the money or whatever, because it has a multiplier. It's the tail. And so similar thing here, CDS in general, have more risk, right? There's a bigger risky environment, and that tail is part of that.
Yeah. There are a couple of other asset classes that you wanted to bring up, which I will set up now. We've kind of hinted at it already, but there is the US dollar, and I mentioned earlier that we had seen some moves in the Taiwanese currency. We've seen a lot in April in terms of movement in the major currencies against the dollar. So I'd love to hear your, how you tie that in.
As part of that, I'm going to start a little bit bigger and work my way down to those, which I think will be great, which is, I mentioned this before, but I want to reiterate the other major thing that I don't think enough people talk about, which I've already talked about a bit, but I want to reiterate, is that, 5-year anniversary of the low in interest rates. We've talked about how there's a lag to interest rates. People have often said, well, look, interest rates have been going up since 2021. That's almost 3.5 years or 3 years. Why haven't we seen a significant decline in markets yet? If this multiple that you speak of, Cem, is the most, the 10-year, the discount rate is the most important thing. Like, why? Well, there's a reason, by the way, that Shiller does a 10-year tape, right? And smooths interest rates over a long period, because variable lags and how those interest rates hit the market. There's always a lag, to be clear. The question is, how long is that lag? And you can't look without some intelligence at the whole picture and determine what that lag is, because it's different during different periods. Why is that lag different during different periods? If you have a significant decline to historically low interest rates like zero, guess what? There is a massive amount of refinancing and capital that gets stored away for the winter, right? And if you store it all away for the winter for long enough, it'll delay that even longer. But guess what? When the thing comes, it'll be worse than it ever was. That's just how it works, right?
Cool.
And so, the lag here is, and we've talked about this for years, there's going to be a meaningful lag. The question is, how long is it? Well, anecdotally, like I have at least 2 or 3 stories. I won't tell all of them, but of people who have taken money in some form or another for about 5 years. Why? It's just logical, as we were mentioning. Like, nobody's going to take money when it's super cheap for 1 year,
right?
But also, there's a cost to taking money for 10 years in some situations. Think about venture capital. I have a family member who is the CEO that once was close to unicorn, right? Guess how long they raised money for? Gave up 20% equity valuation. This was SPAC town, right? Like, there was just so much money flying around. Like, of course you're going to take money. It didn't take money, enough money to last them 10 years to survive. It took 5 years. Guess what? A year from now, they got to raise money. Guess where valuations are? 75% of, or 25% of where they were, or 30% or 40%, whatever they are, right? And that's going to be hard. And that's going to be, importantly, a draw on liquidity from somewhere else. Somebody's got to do that. And if everybody's doing it at the same time, guess what? Those prices go down. And not just on the equity side, but same as with sovereign debt. Talked about rolling over a debt, short-termism. You think it applies to the government too. Janet Yellen, same thing. So this overhang is dramatic. And it's just getting started. And, it doesn't keep increasing, but it does increase until it levels out. And then there will be a consistent amount from there. And there's actually a period where it kind of slows down a bit and then kicks us again. And by then, if interest rates are even higher, then we have an even bigger problem. And this is how this kind of goes. So the reason I start there, though, is that's overhang for particular asset classes in particular. But when you start pulling liquidity from the system, that affects all assets. And this is the thing I've talked about. I don't want to go too deep down this rabbit hole today because we just don't have enough time to cover everything today. But that's why 60-40 is so dangerous at the end of the day. And that's why also the alternatives that are sold to people is also dangerous, which are private equity, private credit, private real estate, because people are taught that investing is just owning assets. And we learn about diversification, but the idea that we need to diversify away from just owning assets is not part of the vernacular. People don't understand that. That's what trend following is, by the way. That's what hedge funds and multi-strategy non-correlated assets are. I'm not here to cut my book, but that's the reality. If the 10-year goes up, the earnings yield of what you need to make in any asset, right? That has to go up, which means price has to go down. It is the most important thing, period. It's not about earnings. It's not about other things. It's not even about supply and demand. It's about the discount rate. Shocking. It said, finance 101, but nobody seems to understand that. And so that diversification is key, particularly during periods like this. But to that note, all assets are correlated, and that's to that one important item. And if we think there's a high probability of that going higher, or there are risks of inflation that long run and going higher, people think assets are a protection against inflation. See the contrary thing here, the problem with this? Yes. If you want to hold value, yes, an asset in theory will protect you against inflation. But if it's an earnings yield or some type of appreciation you're trying to achieve, your multiple has to go down if inflation goes up. And this is why equities, despite people thinking they're a hedge to inflation, are not and have not historically been. Plenty of data that shows that. So to that end, let's get to the other asset class you talked about, right? So how will oil do in this type of environment? Maybe it'll hold its value relative to the inflation. It is a good inflationary hedge. It is at least a core real asset. Its margins aren't going to compress. It can actually improve margins over time if we're talking about longer term. But it is still an asset. And if we have a liquidity suck coming out of the market, you can actually have a situation, by the way, with demand. It'd be maybe a mild recession. It may not be the deepest recession as people think, but where number go down. That's not the only reason it's going down now. I think it'll be less than everything else eventually, right? There are other forces we'll get to. We'll talk to oil here. But also, we're also alienating international buyers from some of these developed world assets at the exact same time we have the supply. I think this is one of the biggest, most important things happening. We're injecting volatility and uncertainty into a system. We're removing buyers right when the selling is coming on the market. Can you imagine a more kind of dangerous environment for the next year and a half? Not a surprise that we get dollar weakness into that. And then guess what? Dollar weakness has a reflexive effect of causing more inflation. Right? Because we've had the benefit of not getting that much inflation. Part of the way we've managed it, particularly on the import side, right, is by lower goods. So right at lower dollar, right at that time where we were putting up tariffs and creating more inflation, we're now getting a weaker dollar and creating more inflation in terms of other imported goods. So it's already kind of a tariff upon a tariff. I don't hear anybody talking about that either. That's a pretty big deal if that continues. So yeah, we want to be more productive on the world stage and export. Be careful what you wish for. Right? We'll be cheaper. Just that's going to take a while, and in the meantime, it's going to be that's going to be painful. And then lastly, let's talk about that oil. Let's dive a little bit deeper. I think this is actually an interesting little topic, and we can get into this in a later conversation maybe. But the one tool that Trump has in this inflationary mess are things that are less liquid and that he can control a lever over, maybe, right, that the markets can't necessarily control on their own. And oil is the biggest one. That's very important. People who saw this at the beginning of this year have made a lot of money on shorting oil. This is the important point for now. Incentives always rule the day. Trump has a problem. He has an inflationary problem. And the only lever that he can pull, and he can pull that a couple different ways, by the way. The U.S. is a big oil producer. Guess what? We're open up as much pumping as we can anywhere in the, anywhere that, no matter how you feel about where and how.
Sure.
That's for sure. Drill, baby, drill.
Yeah.
The other lever is our friends in Saudi Arabia. In Saudi Arabia. That doesn't cost them anything. Doing what they're doing in the short term may cost them something. But every time the Saudis do this, we've done it 20 times the last 100 years, right? Maybe more. It's a big winner for them. Why? There's one thing we understand. If you don't understand it, like one of the easiest ways to make money in the long run is when oil gets really cheap to buy it and when oil gets really expensive to sell it. It takes a while. It's not a 1 week, 1 month, 1 year trade. Why? It's one of those reflexive assets on the planet. If oil goes to 10, guess what? People aren't going to pump. We're going to shut down stuff. 5 years from now, there's not going to be enough supply. And if it goes to 150, guess what? We're going to be pulling it out of the ground any way we can. The price is going to go down. And so the Saudis know this. They play the long game. They got out the asset. So if for some period they got to pull supply off the market and force the price down for a year, that's a short-term pain, but they're going to make a lot more money on that in the long run. So the question is short-term versus long-term. For the Saudis, they have the long-term buttoned down. Maybe not long-term anymore, but so it doesn't really cost them anything. At the end of the day, they ingratiate themselves an important time to Trump. So
you think, just for me to understand your point of view, so you think the surprise from OPEC in terms of increased production was a favor to Trump?
Yes.
Okay.
I'll be very explicit.
Yeah.
I think it's one of the factors. I don't think that's the only reason they do it.
Sure.
But again, this is a game that this OPEC, I won't just say Saudis because that's very specific, that OPEC has done forever. This is not, I'm not saying something that is controversial.
No.
This is the game. They can do it again and again and again. They can remove supply, they can put on supply. And why do they do it? Because when they worry, they explicitly say this, when they worry that there's too much, they did counter the U.S. for some time, right? Because they thought too much supply was coming on the market from the U.S. And they said, well, F you, we're gonna squeeze all your producers out. Okay. So point is, Trump wants lower oil. They're willing to do it. Doesn't cost them anything. There are plenty of, I don't know what the favor is on the back end, but trust me, that's ingratiating themselves to Trump at this point at a very important time. And that is a lever, my point is that he can pull that is not controlled by the bigger forces of supply and demand that he can't control. And so oil, notoriously kind of not only mean reverting, but it can make moves like this because of exactly that reason. Doesn't mean, by the way, it's a bad long-term investment. Keep that in mind.
Sure.
But it does make sense from incentives perspective that right now that would be the one way that they try and keep inflation down. Now, question is, if we do get a asset deflationary period across the board, and right now it's pretty easy for the Saudis to do that because things are not bad. What happens when their budgets start to be a problem and assets go down and there's more risk, and are they going to continue? Like, are they going to need that money? And and then also what's going to happen, as I said, reflexively to all the entities that don't make money below 40.
Yeah.
So again, I'll say this now. You can highlight it. This will be hopefully another one of those ones that we come back to and say, told you so. A year from now, there's going to be, or so, maybe it's 9 months, maybe it's a year and 3 months. I don't know. But there's going to be a generational buying opportunity in oil.
Okay.
And oil names.
Okay, cool. I'm not sure this is the favor they're getting, but I did notice today that it was announced that Disney is building a new theme park and it's going to be in the Middle East. It's not going to be in Saudi though, but...
I don't know how much Trump had control over that, but anything is possible.
I've got a few things and we'll see how many we get to, but I do want you to talk a little bit about the conversation we just released a couple of days ago with Demetri Kofinas, because I did notice that you very kindly on your Twitter feed that everyone should follow, of course, said that it was the most meaningful and big picture conversation you've had in years. And for those who may not have listened to it yet, and hopefully they will after having listened to our conversation today, tell me a little bit about why. I also felt it was a very profound conversation, but tell me why you felt so strongly about the conversation and where that's leading you in your thoughts. And then we'll see if I can tie in a couple of other guests we've spoken to in the past before we get to your current market outlook for the stocks, which I know a lot of people are interested in hearing.
So some people think I've built my mental model on where this world is going, which I've been talking about for 5+ years publicly, on the fourth turning. I want to be clear. I'm embarrassed to say I read the fourth turning 2 years ago. That said, it is so complementary to my thesis that when I read it and I started thinking about these things, I'm like, wow, the picture becomes clear, more, and by the way, I think we have some different views that explain some things tied to the fourth turning that are more than just generational demographics, right? We have a lot of things that we talk about that kind of tie in. Part of what I loved about this conversation with Demetri, and by the way, my first real conversation with him, and I've heard him on his own Hidden Forces pod, but very thoughtful. We definitely align in different ways. Had come about something, again, from a different perspective, but complementary perspective. And I just think that when that happens, really some magical things happen, for me at least, in terms of maybe some thought bubbles and things coming together that unite and make the picture clear. I think Demetri probably had some of the same, right? And so we had a lot of great parts of that conversation. But in particular, there was this part where we talk about Joseph Campbell's hero's journey. And I'd never really tied in, although I'm very familiar with that, obviously, I'd never really tied that into this bigger kind of where we are as a society and this idea of crisis that you and I have talked about, and a need for a crisis in order to kind of resolve these problems. And the conversation took on that track, and it was really meaningful in a lot of different ways that I think are very powerful. Plato had The Republic, right? A book about kind of the individual and then modeling it over society. And it's no coincidence, right? That we're a microcosm as individuals of what society is on the whole. I think that's a very productive way to kind of think about certain things. Not exactly to a T, right? There are differences. But in this context, we did that. And I think the hero's journey, which if people aren't familiar, I'll give a very basic kind of example that, Star Wars is modeled. George Lucas took Joseph Campbell's work and modeled over the story as part of why it's the Star Wars trilogy that was so successful. Homer's Iliad, this goes back to the beginning of time, right? And that story is about basically a hero. I won't go through all the steps, but a hero essentially facing, having to leave society, having to face some challenge, having the free will and the courage to overcome that obstacle, and then coming out on the other hand with success and conquering that challenge. And as I mentioned, the U.S. Is that hero. That we'll see if they'll be the hero, but they are on a journey. Right. Ultimately, we are on a journey here in the U.S. and the developed world is, and its challenges are significant, and it's being forced to rise to the challenge. And a crisis will come. The question, I think this is the part that's interesting, is, will the West be able to rise to the challenge? It did during World War II, right? It has during other turnings, right? Will it this time? And eventually it won't, to be clear. The hero doesn't always succeed. In fairy tales and stories, it does. But the hero doesn't always rise to the challenge. And why doesn't it rise to the challenge? Maybe it's not strong enough, can't conjure the courage, right, to do it, and being scared or unwilling, it fails. And so the question is, what is courage as a society? Right? And an individual, what is courage? It's conjuring. We even said conjuring up the strength, but it's like this idea of taking every cell of your being and being devoted full-heartedly and doing whatever it takes to make it happen. Right? In the case of a society, how do we bring those individuals together? This idea of courage and laying it over as this idea of unity and bringing entities, people, and groups together to rise to the challenge I think is a critically important idea. And I find it very interesting that we're facing, if you compare it, say, to the 60s and 70s, I've talked about that period and the challenges we faced then, but we did rise to the challenges of the time in our own ways at that time as well. And we did it through music and movies, right? And all kinds of, and leaders like JFK, right? And inspirational ideas. We look all back and feel like that. We look at the 60s and 70s as that's the one thing that stays, that it was a powerful time of emotion and art and renaissance, right? In a way, to conquer those feelings of crisis. We feel so disunified right now. And are we going to be able to conjure the courage or to unite? And the question really is one that I think is incredibly important. Where are our musicians? Where are artists? Where are leaders? Who will those people be? Will they rise to the challenge? And what can we do to encourage that? And what are people doing to discourage that? I think is important too. And I think there are entities who understand this much from a bigger perspective. I don't want to go all conspiratorial, but I think there is a concerted effort to disunify the West. This is actually quite explicit. It's well stated. This isn't a conspiracy, right? The question, and I believe actually that they really understand this idea, that the one thing at this time of coming crisis that is critical is unity, or the ability to unify.
Do you remember our conversation with General Robert Spalding?
Yes.
Yes. And if people haven't listened to that, we did this in June of 2024. And I completely agree with what you say. I also share the concern that you raise, and this concerted effort, although he talks about it from a Chinese perspective, the playbook that they put in place back in the late 90s, which includes, and probably we see that, which is also why I'm still, can't believe that we still allow TikTok on our children's phone and all of that stuff, right? But that's certainly part of that. And you could say that what was different back in the 60s and to now, well, social media for sure is different. We didn't have it back then.
There's a tool to disunify,
exactly.
Right?
It's
and by the way, it can be a tool to unify as well.
Yes.
I want to be clear. It can be a powerful tool. It's a magnifier, but they now have this powerful magnifying tool, which we do as well.
Yeah.
And you brought this up. Sorry to interrupt here, but you brought this up earlier before we got on here, which I think was very important, which is at the end of the day, is this unification being also disunification being done from inside?
Yeah.
And again, this will be very unpopular to say, and nobody wants to say it. It's something that nobody wants to say. But you know what? For the heck of unity, the problem is nobody wants to say these things. And again, I am not political at all. I want to be very clear. People will take this as political, but is there a disunification going on from the inside in the U.S., meaning, tariffs? And again, it's fine to put tariffs against the counterparty, but if you're doing it against your allies, this is the West. This isn't just the U.S. This is the West versus why are we disunifying the West? And that's a big, big question that we should all be asking ourselves. By the way, this is the same administration which has shown a desire to be very close to Russia.
Yeah.
Right. So that is an important question. I think if there's one tell that I have that Trump might be a useful fool, that is probably it. And so again, very unpopular. I'm gonna get some hate mail on that, but this is not a anti-Trump. This is, we look at incentives, we look at what's happening and try and opine on what that might mean. This is not an emotional thought.
I want to pivot a little bit in the interest of time. I just want to bring up a couple of things with you before we go to the market update, so to speak, because and we'll have to continue down these paths for sure. But there are a couple of things I mentioned to you before we press record, just a couple of things that I'm reminded about after our conversation with Demetri, as you and I speak right now. It's our conversation actually that we had with Ben Hunt a while back. It's conversations we've had with Peter Atwater about confidence and how that ties into what's going on right now. And by the way, Peter Atwater actually talks about that when you lack confidence, your time horizon gets short. Interestingly enough, in many of the things we've seen, including the issuance maybe of treasury bonds, that it became very short term. So there are a lot of things in there. But if I should just pick a couple of things that I'm thinking about at the moment, and I don't know exactly how to tie it all together. One of the things I've noticed that Ben writes about at the moment is this thing about, do we really know who the real enemy is yet? And he ties it back to the great financial crisis or the subprime crisis, where I guess most of our listeners will still remember what that is. And he ties it back to how people were talking about what was going on back then. People were talking about recession fears. They weren't talking about systemic failures. They were debating whether we were getting a soft landing or a kind of mid-cycle slowdown or whatever. But the real danger turned out to be kind of a structural rot of mortgage securitization that was spreading already. And maybe we see a little bit of that in his mind today, where again we talk about recession, we talk about jobs, we talk about inflation, all the things you and I have just talked about. Meanwhile, maybe the true structural threat is already largely undiscussed, and that could well be this thing about when we hear about, the treasury markets is, dysfunctional, and it's a little bit, but maybe there's a lot more going on beneath the surface, and it comes back to this thing: could we see some real cracks in that one risk-free asset that we all think about as being the safest of all safe? Yeah,
I totally agree. By the way, Ben Hunt has become a friend. He comes to Chicago every once in a while, does a book club with us. So I think incredibly highly of what an independent thinker. There aren't many out there these days. Just want to sing his praises. But I've talked about the sumo market forever, right? And there's so much pressure in this system. So much potential energy. So hard to predict the actual tail, but the distribution is easier, right? Mm. And this is a wide distribution with fat tails everywhere. Mm. Leptokurtic market, haven't used that word in a while. And the reality is we are now unleashing unconventional policy with entities all over the world. This is not one node of uncertainty. We talk about it as tariffs. This is an infinite opening of, release of things that were assumed to be static. And when you release one thing that's assumed to be static, okay, that creates some volatility in the area. When you increase all of these things that were assumed to be static, and now they become dynamic, and they play on one another, right? Like one affects the other.
Yeah.
It's unpredictable. Yeah. It is the definition of uncertainty. But the one thing we know is we now have a catalyst to increased uncertainty in the world of a high potential energy situation. Yeah. And I think that is the big idea.
Yeah. No, absolutely. So we'll see if we at some point get a collapse of belief in America's ability and willingness to stand behind its own debt. I won't have time to go into Peter Atwater's points, but I do remember this whole, the whole point about confidence, I think, and our conversation about it and the book he wrote about it. I think it's probably more relevant today than it was when we spoke to him a while back. So I just encourage people to go back and listen to it. Maybe you and I need to revisit this also at some point. And also this whole, as you already talked about, this thing about diversification, you mentioned it briefly kind of thing. But I think this is really, really important now, because I think people have forgotten what diversification is all about. Diversification is not about making more money. It's about actually building something that's resilient, and that hasn't paid off for a while because you only had to buy 7 stocks essentially, or one index. And kind of this change from passive back to active management again, I think is also something we're going to have to revisit at some point. But as I promised, I do know that lots of people follow very closely what you say about what your expectations about the markets, even though this is not investment advice. Let me just stress that. But we talked about some softness, let's put it that way, that you were expecting. We certainly got some softness for sure. We also got a big bounce, manipulated to some extent, people might say. But anyways, where are we in your framework? And has something maybe changed more structurally after what's happened? Because yes, we did see weakness, but we also just had a meaningful recovery.
So 1 hour in, the people get their crumbs. Let's
exactly.
give them their crumbs.
Yes.
Yes. So we were very clear that after a Feb to March cycle drop of close to 15%, was bigger than that for reasons we've discussed, that we would get a rally back. We said it would be steep. Initially, before all the tariff stuff, we said that might get back to 6,000 or new highs. After the drop to 21%, the new news of the tariff, Elon getting kicked out, all the things that have changed, we have been very clear that ceiling has come down. And our most recent kind of predictions were somewhere between 5,700 and 6,000, likely 5,700 or 5,900 is where would we get back to. Let me just, I finished that thought. Guess where we got to this week? 57.20. And again, this morning, just went and retouch those levels again, right? There's a lot of important levels here. Go ahead.
I was just going to say that. I mean, are you familiar? I don't know whether you follow that, but that is around the area of the 200-day simple moving average.
Absolutely.
Yeah,
Absolutely.
okay.
But there's a confluence. I can name
yes.
probably 7 things that line up there.
No,
it's not,
I just noticed
it's not a coincidence that we're
that.
seeing resistance there. It's not a coincidence that I named those levels as important levels. It's not the 200-day alone,
Sure.
but when there's a confluence of different things, and that usually matters a lot. And I'm not the only one who looks at them, and that's important. So the question is path. And I never thought, we would get there and it just would be an automatic point to point and then we turn, right? Particularly on tops, it's more of a process. It always is, right? And I would see this bigger move as, again, a process. Yes, we had a big dive and a big, everybody's watching it, but like this is a topping process.
Yeah.
It doesn't mean, by the way, that we haven't hit the high. I do think we've hit the high, but it doesn't mean we won't, couldn't go again, another 300 points higher or whatever, right? But why do I think, the ceiling has come down significantly? I already mentioned the alienation of buyers of assets. We already knew the supply piece was bad. Now we know the demand part's bad, and we've injected volatility. That's not good, right? So that's the big reason. On top of that, importantly, we have we have an options expiration cycle. So now we talk kind of more short-term and flows, right? You've heard me talk again and again over years. If people haven't learned this, they should, about flows. Quarterly options expirations are important. Pay attention. It is not just, again, COVID. We've highlighted this. Nobody else ever talked about this until we brought it up, is that COVID started the day after Feb OPEX. It ended the day after March OPEX. That is not a coincidence. The recent decline that we called for, when did it start? The day after Feb OPEX. Didn't decline, end on March OPEX, partially because people, A, get it, and so it kind of makes it harder to bottom. B, everything we just talked about, right? All the things that are going on in late March or middle of March, right? Yeah. But guess what? Here we are. Next week is May OPEX. And you got a next quarterly OPEX, which is June. And June tends to be less bad than a March. And there's reasons for that, because we usually get a big ramp into end of the year January, which then if we can hang on through Feb, then kind of creates potential energy for March. June tends to be after kind of a spring push, which we're kind of getting. And you can get some, this is why sell in May, by the way, happens. By the way, we should have an episode. We just do all the adages, right, and explain how these flows that I talk about literally lead to these outcomes, because there's all of them basically are a confluence of these structural flows. That's why they repeat. But May to June is also a dangerous cycle, less historically volatile, but we'll see. But yeah, I think we've reached our, near our ceiling.
Okay.
And to be clear, It's May 8th. We could push higher before Monday, Tuesday.
Sure.
I think there's another couple of important things I want to throw in that aren't just the option cycle. You always got to look at all the different parts. Doesn't help that this administration, all of a sudden, this actually brings risk forward, is trying to juice the market, clearly, and trying to push a deal through and show some positive momentum to support this market that's been part of this whole rally the whole time. And it happens to be, we're going to announce it over the weekend. Well, okay. But what about when they announce it? And then it's not a deal that's nearly as big as people. That's another one. And by the way, we juiced volatility a bit. Not incredibly juiced, but there's a little bit more risk premium put in now because of uncertainty. And lastly, guess what's on Tuesday? Full circle for this conversation was the first thing we talked about, inflation. What's the most important thing for this market right now?
CPI.
The 10-year inflation. What's on the 13th? CPI.
Yeah.
So when you get a confluence of events and things and potential energy, and you start to understand these option cycles and the flows, and then we're hitting a level, you make your own determination.
And this is why people come back to listen to you and all these conversations, Jim. Thank you so much for all of that. I will plug one thing before we end, and that is if people can't get enough of Jim, actually, they can just tune in again next week because we have episode 2 of You Got Options with Jim. And, I won't reveal who the guest is. Let's keep that a little bit of a secret. It's a great conversation. I've listened to it. It's really wonderful. And so lots of good stuff coming out to our listeners in the next week or so. And of course, if you want to show your appreciation for Jim and all the work that he does to prepare for this, do go to your favorite podcast platform, leave a rating and review. And that's the best way to show your support. If you have any questions for upcoming episodes, you can send them to info@toptradersunplugged.com. Next week, I'm back with Andrew, this time without Tom, actually. I'm sure going to talk about some replication and how that handled the April tariff turmoil. So all good stuff to come. Anyways, from Cem and me, thanks ever so much for listening. We look forward to being back with you next week. And until next time, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.